Good morning, Matthew. Stephen Roman here, president of Global Atomic Corporation. We're a uranium company building a fabulous project in West Africa. And glad to be back here at Crux to give everyone an update. I would also like to wish all of our American friends and supporters a happy Thanksgiving today, and enjoy your long weekend. And we look forward to this chat today.
Fantastic. Stephen, lovely to see you. I know it's only been a short time, but you've done so much in the last month already. Okay. I want to talk to you today, obviously about your feasibility study, the conversation around that, the press release, but specifically about the money you've just gone and raised. You've gone and raised $30 million. Nice price.
Thank you, Matt. We worked on that, and of course, most of the issue was taken up by institutions that we had a mix of both groups that had been in there previously that are continuing to support the company, which is great to see, and then a number of new institutions. So about 90 to 95% of the whole issue was institutional. And we feel that a doubling of our last issue price was a good deal for the company, particularly with the additional $6 warrant, which, if exercised, would bring in about $20 million. And of course, the previous warrants that are still out there that will be exercised next year. This could effectively give us enough capital to move forward without much of any further equity issue.
Yeah, it's interesting. And we'll maybe talk about the contribution from Befesa in a second to that and the kind of confluence of that capital. But just in terms of the deal structure here, you've done it as a bought deal. You didn't want to do a prospectus deal. Why was that?
Well, the prospectus, institutions typically, they like doing prospectus deals. Since this would be our first one, it would come under a lot of scrutiny with the Ontario Securities Commission. That would delay things probably a month or 2 months, at least sometime into Q1 next year. So we felt if we could convince everyone to do a private placement, it could be done quickly, take advantage of a good year-end market. That's one of the reasons why they like to have the half warrant attached, because they do have 4-month hold stock on this issue. And we're expecting to close at or about December 7th. So it's very quickly done from initial bought deal to close. So that's good for the company, and of course allows us to really keep the momentum up. We already have earth moving operations ongoing at site. We have bulldozers, we have buildings being erected. So this momentum we'd like to keep going. And of course, we announced that we would be breaking ground January, but we've actually broken ground already at the end of November. So we just want to keep all this going.
Okay, so again, something to come on to in a second in terms of the breaking ground and prepping of the box cut, I suspect. So just on the money side of things, because you've had a really good year of it. Okay, even since we last spoke, you were 322 up to 395 now, $4 plus a half warrant. I mean, CEOs feel differently about warrants at different stages of the company's development. How close were you to not doing a warrant or being persuaded that you needed to do a full warrant? What were those discussions and negotiations like?
No, full warrant was never the case. So it would have always been a half warrant. I pushed for no warrant, which I agree with you, with a 700 million market cap company. Usually you get by the warrants. However, the fact that we did a private placement and not a prospectus issue, there had to be some concession there. So the fact that the total deal is really minimal dilution in a percentage basis, and the warrant is a half warrant at a much higher price at $6, I think it was justified for the company to go ahead with that.
Okay, good kind of compromise. And you're getting the money in now. We kind of made reference there to Befesa, and obviously at the point at which that could start feeding capital into your bottom line. I mean, when you say we may not need to come back to the market again, Do you think that's realistic? Do you think that you're going to be able to do that?
Well, we've got a number of big drivers here that would support that idea. One is, of course, 30 million of warrant exercise capital available. And the other is two cash flowing businesses. So Befesa joint venture obviously is one that'll be paid out this year. We expect that before the end of this year will be Befesa loan will be paid out. So then we will start generating dividends. We do expect potentially with the current zinc price that we may even get some during 2022, which would be a year ahead of schedule. The other is the advancement of our discussions with Orano as far as shipping, direct shipping ore during our development phase of the mine up to their Sommer plant. So that potentially could start generating revenue early 2023. And so then you'd have basically two cash flowing businesses that would help support financing of your own plant. And the banks, of course, have indicated 65, 35, 70, 30 debt equity ratio. But with the money we've just raised and with the warrants outstanding that could be exercised, we could have that component completely taken care of.
Just remind me the total capex number there. I remember the number from the PEA. I mean, have you got an update on that?
It's almost the same. It's just over 200 million in total. That's with the contingency as well. Gotcha.
Okay. And also with Befesa, just in terms of the zinc price is quite healthy at the moment, and if you do pay that debt down, or your share of the debt down next year, you may get some financial contribution, but typically that's going to be paid out on an annualized basis, probably in the February or the March of the following year. That's the way that cash flows into you, is it? Or
yeah.
Right. And you get management fees.
Management fees and sales commissions every month, and then the big dividend once a year. So typically that's declared in March at the AGM of the JV, and then paid out in April.
Got it. And when will you be given guidance in terms of what you think those sorts of numbers could be in terms of the contribution from Turkey?
Well, if we carry on, and our guidance this year has been that we would be running at about 70% capacity. We think it's going to improve a little bit next year. I mean, if COVID backs off a little bit and we get more steel production, we could move up to about 80%. So that could potentially, if zinc prices stay where they are, donate or generate about 10 to 15 million in profit to us annually. If we run at full capacity, which is about 60 million pounds of annual production of zinc, that would be much higher at current zinc prices. I think the zinc price this morning is over $1.50 a pound. It's a phenomenally good price. So this would generate a lot of cash, but I would say downside would be in the 10 to 12 range, and probably upside 15 to 18, depending on how the zinc price fluctuates.
Right. Okay. And with regards to the feasibility study, what can you tell us? Maybe some highlight numbers that we should be looking for.
Well, the feasibility, of course, we did a lot from receiving the draft in September to the final release a couple of weeks ago, mainly with optimization. And the big cost increase, of course, is shipping rates. Ocean shipping has gone from $2,500 per container to $12,500 per container for no apparent reason, except, everybody likes to blame COVID. So it's gone up 500%. It seems that prices are coming down now. The other big input in the feasibility are the reagents, being sulphur being the big one. That again, we use the highest number that's currently out there of over $200 a ton. Normally sulfur is in the $80 to $100 a ton range. So of course this feasibility we think is going to improve by the time we get into production, and numbers should come down. The other thing we did is because we had enough drill intensity in certain areas of the deposit along strike, those smaller pods were pulled into the phase one feasibility, which added a lot of additional development cost, which you wouldn't normally spend. So we feel that right now the numbers are very conservative as far as OPEX and CAPEX, and we think that we'll be able to improve definitely on the OPEX side by keeping the development of the mine mainly focused on the Zone 1, Zone 2 areas. We're now drilling part of our 15,000 meter program on strike of Zone 2. So initial drill indications are very positive there. We hope to be able to release some news on that in Q1, but that could then focus more of your near-term mining in that area without doing a lot of underground development, which would be a huge reduction in cost. So we think there's a lot of benefits going on here with the drilling and with the further refinement of the whole mine design and mill process.
So I'm really interested in the kind of the margins that may be affected, your margins that may be affected by the Orano discussions. And, you know, are you broadly in agreement about what the range could be, or do they control that conversation? The same with the shipping and container costs. Obviously, we've seen that around the world, and some hilarious stories of where ports, once they started implementing fines for long stay containers, there's a sort of 33% reduction in number of containers there, because these were companies trying to blame the shipping for delays in the supply chain and therefore being able to increase their prices. So we've seen some fun and games at the actual ports. But again, what are your conversations like in terms of negotiating those prices and, make sure that they're not eating into your margin?
Well, one of the big ones has been to source a lot of materials locally. So both in Niger and surrounding countries, we've managed to source both equipment, fabricators. For instance, if you were bringing in steel from China, for instance, and you had to ship it by container, well, that's a container full of steel. Whereas right now what we've done is we've sourced the steel in nearby countries, and we can ship overland without using ocean freight. And we've managed to really keep if people would notice, the cost overall, including the contingencies, is just about where our PEA number was. So we had, I think, 203 million in the PEA and 208 million in the feasibility study. So the more we can do locally and the more fabrication we can do locally, that means less ocean freight, less shipping, less hassles at the port, etc. So this is all working to our advantage right now. We've got a couple of local contractors also that we've engaged, and we've also engaged some experts in logistics that have worked for big mining companies in the region that are helping us now, that know all the ins and outs and who to be using for various shipping. So we're getting those costs down. Okay,
good. Okay, I guess more as you kind of get there and actually sign agreements. And so just on the money front, you are obviously feasibility study meaningfully advanced, quite close to production in the sense that you're probably more advanced than most companies out there. You may not need to go into the market for financing based on what you just say, but if you do, have you been having conversations? Are you getting that lined up as a backup? Because it doesn't sound like it's going to be a big amount, but you still may need something.
Well, until we get the final term sheets from the banks and we can show them our balance sheet and what's coming in on the cash flow side from the operations as well as exercise of warrants, we won't be able to answer that question. So they might be totally satisfied with that. But, if there is a requirement, we'll have to deal with it at that time.
But is there a case of subject to? Because, from my days back in banking, subject to companies achieving certain milestones or criteria, you could maybe get broad terms agreed. I know you've got a, I think you've talked about, just over $30. I don't know where's the number today in terms of your break even number.
Well, our feasibility study, we kept it consistent with our PEA at $35 a pound. Uranium, I think yesterday was around $47 a pound.
So it's getting there,
so
right?
Say again?
It's getting to the point where you think, well, maybe we can go sooner rather than later, or do you, like the rest of the industry, wait for this thing to take off in the new year? Because I think most companies are looking for this 55, 60 level.
Well, the analysts here in Toronto are writing up Q1 as $60 a pound in their forecasts. I think, of course, the last high in uranium back in 2007 was $136 a pound. Clearly we're into a whole new era for uranium and nuclear power here, with all of these countries after COP26 signing on to nuclear power. I think they're now including it in the whole green economy in Europe. So the demand for uranium is very strong. We feel the prices should move higher. Obviously, the key thing for us is to move the project into production so that January of 2025, that's what we're telling utilities, we will be able to start shipping at that time. The other thing I didn't mention is that the utilities that we're speaking with have also discussed potential prepayments because of shortage of supply. That would effectively eliminate requirement for equity dollars in that you would just work and supply uranium into those contracts that some of them have had some prepayment. So these are all things we're working on right now, Matthew.
So lots of options on the table there. Getting into production in 2025 sounds like it's funded, or you've got a very good idea where the money's coming from. But you mentioned utilities. They don't seem to be doing too much in the market at the moment. You say you're talking to some. What about? Because no one's signing contracts, it seems, at the moment. What are they waiting for?
That's a good question. What are they waiting for? I think overall, the general thought was that maybe this was a short-term blip in the market, and that they would be able to, get their supplies in the normal course, that there's plenty of uranium out there. But since those thoughts sort of came across the tape in the summer, the uranium markets changed significantly. So you have Sprott, of course, entering the market in a big way. The Kazakhs have been doing it. Yellowcake PLC. There's a lot of loose material that's been cleaned out of the market, and of course the prices have moved a little higher. The utilities really haven't reacted that much yet, but I would expect as things continue to firm up, they're going to start to come into the market, which will drive prices even higher.
Yeah, I think interesting first quarter lined up for sure. So I got to ask you then, how are you positioning yourselves? How are people reacting to you in the light of obviously Sput doing its thing? I think they've just increased their ATM from 1.3 to 3.5 billion bucks. That looks interesting. ANU, as you say, the Kazakhs doing their thing, and Yellowcake. How do you fit into that narrative, given that you're probably one of the nearest term new production stories out there? Are people interested in that, or are they going and hoping that, Cameco and Kazatomprom and one or two of the other sort of smaller producers will be able to solve their problems? I mean, what's that dynamic?
We haven't mentioned the Chinese announcement that they're going to build 150 new reactors in the next 10 to 15 years. So that's on top of the ones they're building now. China has a big presence in Africa, as you know, and obviously uranium from Africa is part of Chinese supply currently. They will need more supply. Orano, of course, is close by to us. There's others in country looking for projects like this. But as far as we're concerned, we'd like to use this asset as a company building asset. It's a tier 1 project. I think people need to have a little bit of a longer term view in what kind of value we can create in a strong uranium market with this asset. And I think that people have spoken to us and asked about, when are we going to sell? That's not part of our game. So we want to be a producer. We think the mine can be a significant producer, a little bit of a new guy on the block outside of the top 3. And I think that's going to generate a lot of interest for Global Atomic.
You say you won't be interested, but if the price is right, you're always interested, right? And if
everything's for sale, Matthew, at the right price.
Always. But if you look at China and Africa has always been their shopping ground, right, for the Chinese market. And you look at, they've been quite active in buying some of the battery metals, some of the base metals out there, but they're not offering huge premiums. Like if I look at lithium, it's, we're talking 20, 30% premiums. Now, the difference between lithium and uranium is, I guess, scarcity. So if the Chinese value your project properly, you say there's always a right price. Is there? You're open.
Well, you know what, Matthew? One good thing to look at, I would say, as a sort of a comparison is, what are the Canadian companies that are not permitted trading for as far as pounds in the ground? And they're in the $8 to $10 a pound in the ground right now. We're 2. I mean, if we were $10 a pound in the ground right now, we'd be a $2.5 billion market cap company. I think we're going to find more here at Dasa. I think it's going to be something that's going to be supplying the market for the next 50 years. So you have to look at that. You have to look where's the uranium price going?
You do. There's a lot of variables there. Obviously, they're much higher grades over there, so it's going to be the cost of producing the pounds. And you are a low cost producer, but it's going to be tough to get anywhere near them. That said, the multiples they're seeing are significantly more than you are on a cost per pound basis. So you've definitely got a ways to go, and it's a question of what you want to be able to do, and how far you want to take this project, or how where the ambition is on that front, or where the ambition is in terms of realizing a really good price for this thing for what is a typical Chinese shopping environment, Africa.
I guess time will tell, and we'll see how far it gets, Matthew. But with an asset like this and with cash flow from Turkey, we can be a solid dividend producing company, and people can have this in their registered retirement savings plans, generating cash flow for many years. If a fantastic price comes in the door, and I'm talking billions, I look at assets that have sold around the world that are nowhere near this asset, that have sold for $3-4 billion. So I just don't see that this is not going to be a fire sale, that's for sure. We have something that's very unusual. It's the largest, highest grade uranium deposit in Africa. So I think people need to understand what we've got here.
Yeah, we're not arguing or debating will this get into production. We're not debating can you make money. We're debating the type of return you could possibly get on the investment so far. So that's not a bad conversation to be having. Just on Niger, in terms of has there been any sort of fallout with regards to companies exiting the uranium space there? Have you been able to benefit from any of the, over and above what we talked about last time in terms of infrastructure, people, etc.? how are things on the ground, I guess is what I'm asking.
No, the things on the ground are great. Everybody's very excited. We've got lots of interest from people wanting to join the company. We're doing interview processes now. Of course, building up the team on site, getting our camp ready for more people moving in there. So it's been very positive environment. The government, of course, are pushing hard to get this up and running as soon as possible.
Income, taxes, employment, not too bad, right? Well, look, Stephen, look, I appreciate the update. I just wanted to kind of catch up with regards to the money and how you went about putting that together. And obviously, sounds like you're quietly confident about your equity requirements for the next couple of years, and obviously feeding into whatever total capex structure you put together. So, I appreciate your time today, Stephen. We'll see you soon.
Thank you very much, Matt. Always a pleasure. And again, all the best. Have a good weekend. Happy Thanksgiving to everybody in America.